All right. So, hey everybody, whether you're listening in on Zoom or if you're coming in or you're listening on LinkedIn or YouTube, hello, I'm Arvind from SusMafia. Uh, Here to mainly introduce the two very exciting people who are gonna talk about some very important stuff, something that is not usually spoken about. So hopefully we have a lot to gain from today. Firstly, we have our host, Gagan. He's a mafioso. I mean, that's how we like to introduce him. But more broadly, he is the founder and CEO of Plant Electric, a company that's pioneering lightweight electrical vehicles to make EVs more efficient and cost effective, right? So before coming into the world of EVs, Gagan was at ISRO, where he worked on aerospace technology. So a lot of what he's doing with Plant Electric is inspired by aerospace technology as well. So very lightweight structures, so making basically reducing the weight of lightweight commercial vehicles and making them more efficient so that you get more bang for your buck when it comes to going electric, right? So welcome, Gagan. We also have Abijit here, who's our guest speaker. He basically knows the funding game inside out, especially when it comes to capital intensive climate and hardware startups. He's the VP of Treasury and Financing at Gradient. Global uh, Gradient is basically a global industrial water solutions provider. At Gradient, he oversees debt and structured financing projects, basically looking at scaling critical infrastructure. Before this, he ran Ascender Capital, investment advisory firm, where he worked with both early stage and late stage companies, helping them raise capital without giving up too much equity. Right, that's always a important part. And of course, uh, before all of this, he's also worked with 3M, Terry, so a little bit of work on fuel cells, carbon financing, innovation-led industries. And yeah, and before all of that, of course, he also studied at Columbia University, where he specialized in energy finance. So you can see the whole uh, journey. So here he's today to basically talk about more from the financing perspective, and Gagan is here more from a hardware startup perspective. So I'll take a back seat. Over to you, Gagan and Abhijit. And we will come in at around 6:55. We'll quickly open up for questions before we open up for questions later. Yeah. So you have the next 20 minutes or so to talk about the first part of the conversation.
Awesome. Awesome. Thanks, Arvind. This was beautiful. Abijit, welcome. Welcome to the SUS Talk. Pleasure to host you here.
Awesome. Thanks, guys.
It's a lot of things that we're going to talk about today, right? Especially on hardware financing, what challenges are ahead of a startup who comes into this space. How does venture capital work for them? How maybe it does not work for them. We'll touch on that. We'll touch on IP, revenue models, what is accepted, what new you could perhaps do. We'll take questions. We'll understand alternative capital sources, lessons from the global successes. We'll also talk about which are the global successes. And let's get started. Abhijit, any word before we get started?
No, perfect. Thanks, guys. Thanks for the invitation, Gagan, Arvind, Saksham. I think it's amazing that we've finally got to do this. We've been building this up, and I think that definitely this is going to be a start of a lot more in terms of it's an area that needs a lot of attention, and so. The one thing that is interesting is in fact, we are making a session for what's known as hardware startups, when the entire venture industry post World War II was all hardware, right? We were semiconductors and years of only hardware. No one talked about space tech was not software, right? So there's a lot of that is already there. There's a lot of wisdom already in the market. It's just that with the Microsofts, the Googles, and then subsequently with the app and the dot-com era, there's been years of software focus, but we I personally believe that the time for hardware is back. Unless there's hardware, you can't really do softwares and other things on it. You need to have, I mean, Uber couldn't have been Uber if there were no cars in the market, right? So it's kind of interesting. So it's a great topic. Love to start off, Gagan. And
Thanks.
yep.
Yeah, Abijit. So, okay, first things first, right? As you mentioned, hardware. We've historically had the beginnings of venture capital with hardware, and then it broke off. Specifically in India, we've never seen that cycle, right? And we do have a lot of Indian founders here. So for those who haven't seen that cycle, could you shed a bit of a light on what's that all about? How did the conditions look in the 70s and 80s? And today, with climate focus, hardware focus, what would it look like? If you could set a context around that, and then we'll take it from there.
The good thing about hardware, Gagan, is, and especially when we talk about hardware for industries, it is pretty universal. It is not localized where if there was an innovation even if you take a simple innovation like solar panels, it became ambivalent across the world, in a relatively short period of time. There was no part of the world that didn't know what a solar panel is. So if you consider solar panel as an innovation, an efficient solar panel, be it a thin film, be it a photovoltaic, so there is a universality of hardware. So I don't say it's not specifically a regional issue. It money goes to the least resistant places, right? It is a fundamental law. It's just like water, right? So there was enough hardware built from the 1950s to the 1960s, 70s in terms of semiconductors, in terms of computers, etc., for the software revolution to take over. And then when the software revolution took over, there was enough, hardware and enabled hardware through software for the dot-com era to take over, right? So I my personal belief is, we've got with the need for sustainability, since that's the main topic of what we're talking. Sustainable infrastructure, you can't prevent climate change through software anyways, right? So the rationale for creating new hardware startups that are able to innovate, come to market, and then is clear. And I think come 2024, 2025, we would see that renaissance, if I may, in that space.
Yeah, yeah, absolutely.
Did I answer your question?
Yeah, no, partly. And we'll actually pick up on that point further as we go along. Abhijit, when it comes to, as you mentioned, we are talking within the context of sustainability. You cannot arrest climate change with software. So hardware is critical. We have a lot of research that comes out of universities, apart from universities, pulling these solutions together. And fundamentally, the reason we are talking about this is because from every single entrepreneur of my peers, all I hear is there is not enough capital, and I have struggled for the last 4 years for finding capital. Right.
Yeah.
So, walk us through the journey of when it comes to seed and then going to scale. There are like 3 or 4 different stages. Where would you draw comparisons with a software startup and where you wouldn't? And if you can then extend it into the critical role of, say, IP in enabling that, the critical role of actually building, something hands-on, showing that POC, and that role in how it enables seed plus Series A scale sort of financing for these startups.
So great question, Gagan. And I think in that it's actually a two-part question in that sense, where if we're talking about stages of a startup, hardware versus software, I think the first fundamental difference is a lot of software companies have to grow fast to reach a certain point in terms of either market share, or has to actually have enough eyeballs, enough subscription, because there's really, it's very difficult to, and on your other topic, IP, very difficult to patent or protect or create a moat when it comes to software businesses, right? You have to generally move fast because the enabling hardware, you don't, most of the time, don't own it.
Right.
No one, your investors don't want you to own it as well.
Yeah.
And you want to be asset light. So you have to really, it's a run, it's a run, it's a run. And it suits what early stage venture capital also likes because they're like, yeah, you run fast. Give me my ARRs, give me my returns. It's a valuation leverage game.
Yeah.
And that is fundamentally different with hardware. Hardware cannot be force fed, it will take its time to develop. And the fundamental difference is piloting. Hardware starts with pilots. So if you do not have a pilot that is working and able to, has generated quality data at a seed stage, I think you're wasting a lot of time by just saying you're a hardware startup or you're building it up. So piloting and generating data. And that the other myth that people have is if I'm doing anything in the hardware space, it has to be like 10x, 100x, 200x, 300x delta between what the baseline is. Absolutely not true. You have to be marginally better and also some improvement that you're able to generate at the seed stage, right? So that's the seed stage. And I think we'll talk a little bit more of IP subsequently because it's an interesting spot, and that's where there's a lot of difference between the East and the West. We'll talk a little bit about that. But then on your next stage, which is basically like, post-seed, like kind of pre-series A, that's your stage where you have to have customer traction. And in this case, I've seen a lot of startups actually, when it comes to customer traction, needing to demonstrate there's an AR ability in that traction. They believe that that is the basis on which they can actually float. Again, not true. That's the main difference between a software and a hardware. In a software, again, at the mid stage, when you're showing customer traction, you do need to show ARRs because otherwise you're not showing that you have a moat and that people know you and what you exist and where you exist and what you exist for. But in hardware, again, your first few projects need to generally generate some amount of revenue. There has to be some kind of customer happiness that you're able to evaluate and demonstrate. And then the third step, which is scaling up, software is not as conducive to non-dilutive capital as hardware is. And that's the beauty of the sector that we work in. So I've had backgrounds in large-scale infrastructure, where equity was always a scarce commodity. No one would say, "Oh yeah, let's put a solar project and spend hundred. If it costs $100 million, I'll put $100 million of equity again." It never happened. And so equity was always. So I come from the background that equity is a extremely, you know, it's a priced commodity, and I can't just give it away. So that's where the non-dilutive part comes in. And I think that's the two fundamental differences. And scaling, and when you're scaling up, you have the opportunity in hardware to actually focus on other forms of capital that may be limited in software because in software you're not creating hard assets at the end of the day. So that's about it. And the IP question, I can take up the IP question as well.
Please, yeah.
This is where, initially when you asked me about the difference between the West and the East, right, of India and just,
Yeah.
it's intellectual property. We've never, even though we've generated so much IP, and I'm saying this, my own experience in the Indian Institute of Science, right, last year, final year of engineering, we did some really amazing fuel cell research work. But the drive for our PhDs and post PhDs to publish papers and get their postdocs and stuff, as against going down the patent line and kind of building intellectual property, launching maybe it's changed now. I'm definitely a little old to say it's not happening now in India. I do not know. It's possible that institutions and we've got some of the best institutions globally in India. So IITs and IIScs of the should really focus on that. But the other thing is, even the licensing piece, the part that there was a whole and this is the other main difference, that the licensing piece between university and industry is phenomenal on the West. Most of the biggest, best companies that have been formed and who have, either reached unicorn statuses or, gone about for public listing have definitely used university like IP. I find that lacking actually between the regions.
Got it.
Might be a lot of points you might also be able to add, Gagan, on this since you're building IP.
Yeah, see, for us, the journey has been, the first year when we were looking at bringing aerospace materials to automotive, it was just about figuring out the feasibility. So it is material selection, we're simulating, we are material testing, we're figuring out a new way to design, a new way to manufacture, figuring out with suppliers what can we do. So there is so much that goes behind the scenes before we can even file a patent, and let alone get to a prototype. So building a prototype requires that initial pre-seed capital. Now that pre-seed capital can come on the basis that, hey, the founder has done incredible stuff before, give him the money, give her the money, they'll do it. Or, okay, you have something on paper, right? And that's where I wanted to really actually even shine a bit more on IB, right? Let's consider startup A and B. One startup, you're trying to create a 5x outcome. The startup B, you don't want to wait that much. You want a marginal improvement. You want to go straight to market, right? I would assume IP creation is in the first startup. In the second startup, you're basically saying, let me get some money first, and then I'll figure out how to improvise, innovate further down the line. In both of these scenarios, how do you see, not just from an IP perspective, but from a investor lens, how do you see them going about doing it, and which is preferred, which is not preferred in the initial stages?
Just repeat that question. You're saying the two startups or two stages of a startup?
No, let's take two different startups strategies.
Okay, different startup. Okay.
The first strategy is, I want to really create a 5x, 10x outcome.
Okay.
And
Yeah.
to be able to do that, you need to have a really good technology, well
Yeah.
researched,
Yeah. Yeah.
definitely
Yeah.
patentable, right?
Yeah.
Second startup, marginal improvement,
Phenomenal. Great question. Yeah.
right? You're just for figuring out, how do I get to market immediately? It's not trading per se, but it is trading plus one, right? If you
Right.
may. So how would
Absolutely.
the approach be, and what would you,
That's-
how would you advise?
So it is a clear IP game, right?
Yeah.
And it happens globally. And that's one thing that's missing in India. And I think, focusing on building deep tech, really strong intellectual property. I'll give you one more example on the startup A, right? The biggest mistake, it's not like startup A's have not been created in India. There have been innovations, and I've personally seen innovations that could have become multi-billion dollar companies purely due to IP strength. It is, however, sad that understanding intellectual property is quite poor actually in the country, even within the institutions. For for example, this particular startup, without taking names, had some extremely strong innovation in the battery space. They filed an Indian patent. They were doing really well, but they didn't file a PCT. Simple stuff like that. Without filing a PCT, they were clocked out on their time. And by the time they came to filing US patents, the technology was already out there in the market and everyone was doing it. And in fact, I remember having a call with the founder sometime back saying, man, dude, like, this is already happening. How
Yeah.
did this? There's like, oh, yeah, we only patented in India. Innovation doesn't have a zip code or a pin code. It has to be global, which means your patent portfolio has to be global. And it doesn't mean you spend millions of dollars on a patent, just file a PCT. Simple. You've got an IP, whichever part of the world you are, file a PCT, speak to a lawyer. There are multiple ways to protect yourself in startup. That's what startup A on the IP game. The startup B, which is marginal IP, you still need an IP can come in different forms, right? One is the patent, that's what we spoke about. But there is that initial team that puts up, takes that tech, goes to market. That team cannot, that's like the central, that's like the, I would say like the yeast in the bread for the company, right? And that initial team that goes and sits in the customer's fence and puts that first pilot up is your intellectual property. So protecting that first team, you call it an R&D team, you call it a new team, kind of whatever, new products team, whatever that team is, that is important. Data that you generated at a client site is super important. What you said, Gagan, that demonstrable delta, right? I've got a 5% more efficiency, or I completed something in two days earlier, or I've saved X amount of electricity in what I'm doing. able to demonstrate that, I think is super critical. And I think that could that so the piloting takes a lot more importance when you're just marginally improved. And that's when you should choose customers who are known to be troublesome,
Yeah.
so it actually
For an
helps to have
extraordinary
data.
proof, perhaps.
Exactly. It really helps. And people, it's like it's a little bit more difficult, possibly. They're going to ask you a million more questions, but believe me, every minute of that time that you spend with the
Yeah.
customer is valuable. So,
Yeah.
especially if you're not going IP, because if you're doing IP, the other problem with IP is you still have to raise a lot of capital. I mean,
Yeah.
just because you have an IP and you want to do 10x, 20x,
Yeah.
it does suck in a lot of capital to keep patterns and kind of build it up. And you're, I wouldn't be surprised that in startup A, if 70 to 80% of costs in the corporate SG&A are all intellectual patent development and preservation.
Yeah. No, with you, absolutely.
So these
Um,
are two main difference, right? And both have their space in the market. Both are needed because also the startup A, your go to market is not going to be that simple. The fact that this is the other thing I have seen, at least, and kind of going on a slight tangent here, but I'm sure you'll pull me back in terms of um, when you're trying to do anything on the sustainability climate change standpoint, right? You're primarily trying to disrupt red ocean markets. These are markets that have been there for hundreds of or thousands of years, right? I mean, maybe hundreds of years at least, since the Industrial Revolution was about 300 years back. So let's just say the hundreds of
100.
years.
Yeah.
It's not that easy to come and say, I've got a new cathodic material for the battery, or I've got a new, material that we can use for a solar panel and expect industry to absorb it. So you do need to have an IP, and then you have to keep building it up. But there are exponential benefits out of it. But if you, on a preference part, I still believe the startup B has a much higher chances of success, because
Yeah.
you're just making yourself relevant to the market, because the
Right.
market likes 5%.
Yeah.
It's the human mind can't absorb 100 200x delta. It's very difficult for the human mind to absorb it. So when you go to a customer and say, I'm like 100x better,
Yeah.
like, dude, just get out of my seat, right? Because I'm trying to serve my boss here, and I'm trying to keep my job, and I need to go home and take my kids to a movie. So tell me, what you can you give me 5% more? It's like,
Yeah.
oh
Yeah.
yeah, but I'm not here for 5%. So I mean, that's a debate, right?
No, with you, Abhishek, pulling you back now. So, I'll stay on this analogy that we have created, and I'll say startup B, who's immediately going to market, has anyways reduced friction for investors. Let's not talk about them. I think they are going to go out there, they're going to build revenue, and hopefully they will innovate in the long term. Let's come to startup A. Now, startup A is solving a problem that there is no way to incrementally solve it. It is either 0 or 1. So you are really going for the moonshot. Now, in that moonshot, I want you to put down 3 things, right? What are the most critical stages of this hardware startup that they need to pass? Milestones. Give me 2 or 3 milestones. Number 2, give me a revenue model or 2 that VCs are going to prefer with this when eventually the IP can commercialize. And number 3, how are you going to finance all of this? It's a lengthy thing. Take your time, but we'll start on the top.
No, absolutely. And I mean, well, on the three things that you said, right? Like, in terms of in the early critical stages, what are the most important things to do? And so the revenue model and the financing, once you've taken care of the critical stages, startup A and startup B will have similar revenue models. The revenue models might not really be so different, but financing, yes, can be very different as well. So let's talk a little bit about all three. So intellectual property oriented startups, or what you call moonshot ideas, are definitely uh, your the most the two critical things that would be super important is I would say that if it is if and it really depends on where the intellectual property came from. I mean, like I'm assuming if we're talking about a real game changer type startup, like what is a startup A that has a phenomenally fundamentally different innovation, right? They're just inventing a new form of energy, for example, right? Let's
Yeah.
just say, fusion, for example. Typically, it's associated with the university. It's going to be very difficult I do not see where else can be a source of intellectual property or defense. But of
Yeah.
course, defense licensing is a completely different game. We'll not talk about that. The majority, let's just take university.
Yeah.
The most critical part of something that's really building an IP and kind of an IP type moonshot type company is the team, man. There's nothing more important than the team. You have to have the people who actually invented the PhDs behind it, or whoever it is, as part of your company, either in a co-founder form, advisor form. They could be, even if it's a prof. Early stages, it is about if you are really claiming you're going to change the world, you have to show it in your team, and you have to have the early team that have your licensing agreements rightly written out. The
Yeah.
licensing agreements also has to be in such a way that the university takes a percentage of the revenue or something like that. It's not like an upfront fee that you're stuck with and you don't know how to, get it to market. So that's on the just your team and your licensing, and definitely have the right lawyers. The second thing is it's not a one-time process when it comes to, if you're really making moonshots, you have to constantly keep the most critical aspect of it is to find the specific area that you've innovated and create circular IPs around that so that you can protect your core, and you will end up, having an IP portfolio of, 200, 300, 500, 400 patents if needed, but it is going to be critical because that's going to be the foundation. And in terms of the kind of next steps on the revenue model, right? That, as I said, see, hardware has a certain revenue model, Gagan. It is, and that's where I'm never a big fan of ARRs when it comes to hardware. You don't need to have it. Both the startup A and startup B, if you've got a great, you have to pilot it, have pilot revenue, and then move from pilot revenue to kind of project revenue. Project revenue is completely fair, completely fine. It's awesome to have. No repeatability, it's okay because what you're bringing into the market is actually demonstrable and it
Yeah.
can get repeated, but with a different customer. So don't worry about that, right? So I think revenue model is fairly same. There has been, again, because in our generation, I think since we came in the software era, like we were all kind of born during the Microsofts of the world, and then moved on to I would say the Ubers. So we've been taught to force fit our revenue model, ARR model to the time. Okay. To force fit our revenue model to hardware, absolutely not required. So project revenue is completely fine. We can talk a lot more about revenue model subsequently as well, but so no difference in financing. I have seen um, this is where I think when you're talking about startup A, investors and marquee accelerators who know certain areas in which you are actually innovating are super critical. It's like if you have to it's like to be the part, you have to look the part, right? Like in the sense you have to be surrounded with similar intellectual property companies in a certain cohort, in part of a certain accelerator known for it. And this is where I think again, in we need more such, deep tech focused accelerators that are actually
Yeah.
diligencing and curating IP. We see a lot of that in the US, right? We've seen, we have Cyclotron Road in California. We've got Greentown Labs in Houston and Boston. We've got the Engine in Boston. So there's a lot of this high university IP, amazing founders, great team, and kind of teams that are PhDs from the lab, no business talent, no finance talent needed. These are pretty commodity. You can always get them at any point in time. I'm not demeaning myself or anyone else in the process, but what I'm trying to say is the core is available and these incubations really work. And I think if you're looking at startup A type, we're focusing on more startup A, I think that is going to be critical. So incubators and certain investors who then automatically become part of those accelerators are important. Competitions at that stage are important. Winning competitions for your innovation is important. Corporate venture houses or corporate entities saying that yes, you do have an innovation and we are interested to do a pilot or an LOI are important. So I touched upon all these points kind of broadly. I hope that was, if there's anything more specific, we can always deep dive in.
No, absolutely, absolutely. Before deep diving in, I mean, let's sort of take a step back. I just want to lay out what we've discussed. We've discussed startup A, very 5x, 10x prominent on IP. We have discussed startup B, incremental 5%. Let's go to market very soon. Startup A is where most of the focus is because we want to solve that. We want to solve
Yeah.
that. We've talked about certain levers with respect to not milestones per se, not levers. You create an IP. You get some customer feedback, you create a circularity around your IP, whatever is defensible. You go to a POC, pilot revenue, perhaps a small plant, steady state revenue, you then infuse large capex. And different stages require different forms of capital. We've talked about accelerators, we've talked about winning competitions, and then figuring out the relevant VCs and family offices who have the expertise, who can actually help you in the long term and actually fundamentally, understand you in the first
Venture
place.
houses,
You
yeah.
actually
Yeah.
okay, now let's really deep dive into capital. Where is the capital coming from, right? One is specifically on the seed stage when the founders are no longer enough. You need a small team. You have done the basics at a university or outside. Now you really need to go file those multiple IPs and create that POC. You've gotten some custom feedback, and that is something founders typically generally do by themselves. Now, who are these people who are writing the first checks? Let's go there.
So most of my experience has been, and this is not, I mean, I'm not necessarily talking about, this is in fact not having too much relevance to Gradient itself, but even in my investment banking days, we've gone through the route of trying to talk to institutional investors for early checks in hardware, right? I'm sure
That
all of us
works.
have gone through. No, it's never, that's what I'm saying. I'm saying we've made that, what do I say, taken that leap of faith and be like, okay, you know what? They will understand, man. Let's try to explain. Never happened, right? And so, the most of the times, I think your first check is definitely written either by a customer who
Yeah.
finds you of value. I have found in certain cases a customer liking the innovation so much, saying, if I'm giving you your first project, I want to have a stake in the game.
Yeah.
And I've actually had a couple of cases where the customer came in and at one point in time wanted to just acquire the company at such an early stage. And of course, that's not going to happen, but they were the lead investor. So that is extremely possible. I've also seen the first checks written by government institutions like R&D labs and stuff like that. Again, in India, again, there are few. I wish there were more, but we that's not really an area that we can. But university, and again, being part of that. Ecosystem actually does help your first checks from an R&D standpoint, and these are completely non-dilutive. But other than that, family offices definitely. Family offices that have associated industry in the innovation that you're doing is definitely people who understand and who are willing to give you more than one meeting to explain what you've done or where you are. But that's where the team is important, Gagan. Because at your first stage, no one can see. There are a lot of IPs that are not actioned or brought into commercial mainstream, and so no one knows even a really solid IP will it really stay, and that's when the team comes in, right? So just making sure that your team is incentivized again through equity because you can't incentivize a PhD three-member PhD team with cash, right? It has to be an equity kind of a structure, and the fact that and then I think family office has definitely been a source of early stage, the first checks, etc. because they sometimes understand it. And the other one check, let me put it in here, though it takes a lot of time to get them on board, is corporate venture houses. But typically, even though people really drum up corporate venture houses really well, I have had mixed experiences with corporate venture houses. So with a little bit of caution, I would say corporate venture houses can also be a good, kind of a conduit for that. But you have to be a little bit, kind of tread with care when you're working with a corporate CVC.
Gotcha.
So that's with regard to early stage checks. Sometimes I've also found that you could potentially, uh, if bootstrap it to a point. I've seen one company, and I'll take its name, Spruce Up. We tried to get the first check for the company when I was doing a Cinder. Spruce Up creates mechanical litter picking thing. No real IP, though it comes under Section B kind of a thing. They were mechanical litter picking. The first check was actually written by a customer, not from an investing standpoint, but from a good margin contract standpoint. So they got the contract, then the team went back and used the contract, bootstrapped it money, put the first project in the place, had that 40-50% gross margin that directly came back to the company, fed the company for a small period of time, and then went and did another project. Till date, they're bootstrapped. They've not taken external capital. So,
That's brilliant. I want to actually push a little deeper into this question. Actually, say, and there are two parts of it. Number one, we do see customers offer projects on consulting basis, right? Whenever you're new, you're doing something great. Like, okay, this company, we've not been able to do this internally, so this startup probably can help us. Let's take a leap of faith, give them a small contract. What should an entrepreneur do to convert that small contract into the corporate jumping up and saying, no, not just the project, I also want to invest in you? What is that bridge or the gap, and what can an entrepreneur do?
okay, this is amazing because I think one of the easiest way to do it is have agreed milestones within the contract and prove those milestones to the company in return for either an investment or a larger contract. And again, there are two stages to this. Sometimes you only get a pilot contract, and they're like, okay, you know what? This is just a pilot. This is your contract. But then I have seen a lot of startups get excited with that contract and take it on, but there's no real milestones, there's no real agreement as to what happens if I achieve those milestones, right? So if you've managed to spend that much energy, time, and effort to get an LOI or even a pilot with the customer, you have to bind them at that stage in either, I wouldn't necessarily say investing, because that's something that the team that you're talking to is not the team is not the investing team. So you can't do that. But once you,
Right.
yeah, go ahead.
Right. And that is, I think, a big challenge, right? I mean, say as an
It
entrepreneur,
is.
I want to have you invest. I don't mind, but how do I even begin that conversation with a customer, right?
So in my personal experience, I have found that first of all, not you have to be so media rights, publishing rights should belong to the startup.
Hmm.
Intellectual property should belong to the startup at an early stage. We have to be very careful about these two things. Okay. So when you go and do the pilot, you go to the and I agree with you. Sometimes the customer's like, I've already given you a contract, and so I've done you a favor,
Yeah.
right?
Yeah.
So in a way, I think they're not wrong. And trying to get to his colleagues or his or her colleagues in another department that does investing is a little bit more challenging. Go to the races with that contract. Go on media. Go on, say, hey, I've got this, I've got that. Do like, road shows that I've done this. Like there should be nothing in the contract that prevents you from doing that. And once you've done that, there will be inbound interest, because there are people whose money is sitting in their pockets and they're not happy about it, and they would want to actually make that meet a company that has actually had a customer saying good things about it. So I think it's because I mean, that is I agree with you, Gagan. Getting within, and that's why I said, right, CBGs can be a little bit of a pain at
Yeah.
times because of
Yeah.
this reason, because it's so big, and they only the other problem with corporates is ultimately when it comes to investing, there's so much that they have to hurdles that they have to cross because
Yeah.
most of them they are most of the time they're publicly listed companies. So investing goes into totally different like how much they're going to have an accrual on a share price and all that
Yeah.
stuff discussions, and I've been part of those discussions and they can be nasty. And
Okay.
I've been in part of the discussions in the sense the brief period of time I did work as an offshoot of a corporate venture house, so we were doing the diligences and sourcing deals, and I would feel like 15 deals, all of them investable. But by the time it went into that loop and spoke to them, we're like, okay, how much is this startup going to make a difference to my share price when I go with a media
It's very
article?
difficult to quantify at that early stage, right? I
How
mean,
do you do that,
yeah.
right? So that's where they're bound for. And so I think that's where, again, to your earlier point, family offices, you go do a great job with the customer, right? A lot of family offices know the customer would not give you a contract or give you a tick off that easily. And that family office could be writing your first check. So I think it's about playing both and kind of horses for courses in that sense. But yeah, I mean that's your first check is, of course, that's the most difficult thing, right, Gagan? That is where the proof hits the thing. But I still think if you're confident with your technology, if you're confident with your IP, you know that you hit you see that it's like you can't take it's like you can't take a Ranji Trophy player and have him as your brand ambassador and put billions of dollars in it and thinking you'll be great, right? You will still need, you'll rather take a Dhoni to the market and put less money on Dhoni rather than spending on other things, right? So I'm just giving a bad analogy. I'm sorry.
No, no
No,
worries.
no,
I think
but
you conveyed the point. Yeah, no, yeah. I want to get into a few questions. Now we are running out of time, and we want some audience questions to be taken up as well. And I also want to talk about Gradient and your experience, and what can you talk about how Gradient became a success? Like what were the good things that happened for Gradient? But before that, okay, two quick questions. First, we'll come to the asset class called VC, which we know a lot and is marketed a lot. Now we understand traditional VCs are asset light. They want fast scale like software. Hardware has long prototyping. You have supply chain risk. You have high upfront costs. All of that. Now the simple question is, a startup's going through this journey. They are doing IP. They are prototyping. They are figuring out customer, getting one small pilot phase contract. Where should you expect the VC, whether it is a small or large, doesn't matter, to infuse the first check? And at what point in scaling do you want to even look beyond equity and look into debt? These phases, if you could critically define and explain.
So once you've done a pilot, and once you've got some really strong results coming out of it, be it your startup A or startup B, you have the most important thing, which is credible data, and the advantage with hardware, specifically when you're talking about hardware to the like B2B hardware, is it's very repeatable. It's super repeatable. I mean, I don't know how many of the listeners here are at that stage, but once you've done one pilot, you've understood it. What will happen subsequently is your cost of piloting reduces. So your first pilot will always be 10x
Of
what
course.
your fifth or the sixth pilot will be, right? So don't worry about that, right? I mean, of course, you have to raise money to make sure your first pilot is relevant, and that's where moonshots are generally more rare. Gagan, the type B, more, if you talk
Yeah.
about hardware startups,
Yeah.
out of 100 startups, there'll be only two or three moonshots really existing. 98. So that's why I was like, I'm gonna slowly tend towards talking more on the B side, only
Yeah.
because there's so much.
Yes.
I'm a big believer in more B than A. If you're in an A, then just get governments or some really big institution to already back you before you come out. Like Google Ventures, for example, they do that, right? Or Breakthrough Energy Ventures. These guys have their own internal incubators, go to universities, pick up license. They're like, oh wow, this is great, and back them even before they're in stealth mode for like 15 years. I'm just joking, right? Like not 15 years, but they're in stealth mode for a long time. So you don't even know how they became a moonshot success. So with Type B startups, I think the critical point when you shift from early stage equity to like mid stage debt, and there was not necessarily so one is we're talking about venture equity, and on the other side you're talking about bank debt.
Right.
Between these two, there are a million different structures, and they are extremely a wide variety of funding options, right? You've got venture debt, which was a new product in the last 4 5 years, pioneered by Silicon Valley Bank and a lot of now banks. You've got, I think, Trifecta, with a few other startups in
Right.
India started doing venture lending, some of them through NBFCs and AIF. So early stage, like you do have this ability to, it's kind of this segment. But before getting there, I forgot to mention one important thing when we talked about revenue model, etc. And I know in the past I said, look, ARRs are not required and stuff, and I still stand by that. But it is always useful to build your hardware startup from a contracting standpoint as a hardware as a service. You're bringing hardware in the market, but think about what your hardware is doing to service the client, because that allows you to structure your contracts in a way that creates bankability when you go for other forms of financing. And this itself is like a to a discussion that we can take it subsequently. But writing a contract allows you to kind of service the customer, will quite easily get you this non-dilutive capital that I'm talking about. Having contracts that are and also as part of that is, if you're a hardware company, you keep in mind you will need some really high accounting standards that you have to maintain, because you'll be dealing with inventory, you'll be dealing with PP&E, you'll be dealing with a lot of the balance sheet items that typically softwares don't. So there's a little bit, and I've seen this in early stage, Gagan. I've seen there's a little bit of callousness, like it's like, "Arey, I have a P&L, I'm projecting my P&L looks
Yeah.
great and all that," but
Yeah.
no one looks at the balance sheet many a times,
Yeah.
right? And so the balance sheet becomes, and this is maybe possibly another point. Make sure you understand what a balance sheet is if you're not a hardware startup, because
Yeah.
your balance sheet is what is going to help you. A high quality balance, a P&L is going to help you get venture. Your
Yeah.
balance sheet is going to get you debt.
Right. Right.
Uh, Equity investor looks at the future, a debt investor looks at your past or your present. They do look at the future, but and your past and your present is not your. I mean, P&L definitely does it, but there's a huge thing. So it's also about keeping those things in mind, and the pivot point. See, it really depends. It's very difficult to say when do you pivot, because it really depends on the startup and what kind of you're doing, what stage of the of if you're on a startup A type, you'll never pivot to debt for years because you've got enough of your early stage. Yes, but if you're on a startup B type where you've got marginal innovation, or you've got another, and me too's are completely fine. That's the other thing, right? The venture capital world has, or at least I said, I can't be a me too. Absolutely not a problem being a me too in my hardware. That's the most awesome thing, because the market is so big.
Right.
You don't have to have there's, see, there can only be one Uber or one Ola in the market, or maybe three, right? But there can be 20 hardware startups catering to the market. No one cares. And ultimately it becomes, there was enough for it to move around. So I think it's also about even if you're a Me Too hardware startup, you still can, and or if you're a type B type of startup that we spoke about, you will be at some point in time moving to this form of capital. So keeping your balance sheet in take, making sure your audit process are good, are all important. I don't know if that answered your question.
It does. It does. I think there's a lot of good advice to unpack in there. And I think this will hold very good for anybody figuring out,
You
okay, I'm not getting equity. What else
Yeah.
can I do at this point of time or at every point of time in the journey? And knowing that there are alternative sources of capital. We of course haven't discussed much about grants. I mean, most founders do explore grants. We don't have good enough labs in India. IIT Madras is changing it. We have some innovations come up. We have some structures coming in. I think slowly India is changing. From a global front, of course, we have a lot to learn from. I want to get a little towards the end now of our Q&A, and then we'll specifically take questions. There's something very important that while we're preparing for this, we talked about blended capital models, right? And we have already talked about equity debt. Is there when somebody's looking at VC and will go to startup B right now, how much equity in the system before you raise debt? What are debtors looking at, or what is venture debt looking at as a prerequisite that I even will start? What is the asset quality? Are there assets needed? And if you could give 4 or 5 pointers before you can actually start accessing non-dilutive capital, and then with that now non-dilutive capital hit the milestone to get equity again. Yeah.
So non-dilutive, you're referring to non-grant, right? You're referring to like debt, right? Yeah,
Debt.
got it.
Yes.
Yeah, because again, grant is another
Right.
one-hour topic. So if you start that off, it'll be interesting. Because that is, and I will say, grants are becoming again, um, innovate local but think global, right? There are extremely there are enough markets globally looking for innovation. So if you've got a good innovation, don't sit in your backyard and try to do it. There are grants available. There was a lot of stuff. There's a method to the madness. There are experts just to help you get these grants. So I'll get there on the thing. Or in terms of non-dilutive, when you talk about debt, right? Again, the the it if you are building if you're genuinely building a hardware company and a hardware startup, you will have generated sufficient amount of, you would be in due course generating you would be having inventory, you would be having plant and machinery, you will be having receivables from the customer. All these are assets. You'll be, of course, generating some form of goodwill and IP. Each of these components have a leverageability in the market. Each of this, there are specified lenders, and in lenders, again, in India, the market is slightly, of course, smaller and it's not as innovative globally, but there is still, especially for like, and that's where I would come in and talk about, and that's the other unique part about what we are talking about here, Gagan, you, me, and the entire SUS Mafia, and this is the beauty of the sector we believe in. There is climate finance. There is carbon financing. There are lenders will not touch your company because you're doing coal or something else, or you're not in the sustainability space, you're creating some IoT product. Yes, there's a problem there. But if you're doing sustainability, there are specific lenders specifically doing work with early stage startups who are cutting the first 5 to 10 crore check for lending. But they definitely want to make sure you've got at least a couple of years of, some kind of a history. Even if you don't have, and that's where some of these lenders who are coming very early stage are looking a little bit into the future. So your first pilot, who have you done your first pilot with? What are they saying? And they don't cut checks more than 5 to 10 crores. That some of these lenders that we can talk about or we can share in our next call. But there are within India as well who are doing that for sustainability startups. So I mean, they're most of them are not they're easier Google search away. But so climate finance also demonstrating carbon, like that you're doing something additional. You a little bit of carbon finance. We're talking about additionality, and you're saying that you're doing something that is beyond baseline, has a lot of European dollars waiting to get, right? So there is a lot of DFIs who are looking at that who don't mind coming early stage. Or you can still piggyback your solution on a larger project that is already sourcing DFI or some of the other financing
Right.
and try to bootstrap that, right? So contractually, you can mitigate your risk and mitigate someone else's risk by making innovation. So piggyback on a piggyback on a customer who's a customer to another larger customer, and then wrap the whole thing up and you take it to a DFI, and so DFI capital is at least 300, 400 bips lesser than any domestic capital you can get in India. So there are these structures we can talk. But again, debt and hardware as a service and that structure is an amazing topic to talk about, and I think we can easily devote a complete hour for it next time.
Absolutely, absolutely. One last question, and this is the last. You've mentioned multiple sources that are available in the market and strategies. If you're if on from the audience, like the entrepreneurs, how do they go about talking to some of these experts or figuring these out? Are there links that you would suggest? Anything that they could access perhaps after this?
I can definitely send. So as I said, right, in India, yes, I can put together a list of some of the early stage support network, if I can call, because I definitely, I did do most of our when I was doing a center, I was in India, did quite a few transactions in India, and so definitely met a lot of early stage folks. Happy to give links to accelerators or early stage debt plus both. But I would definitely like the startups who are in India to stop thinking that they're Indian startups. Their hardware is relevant for the global market. It is completely okay. And I'm going to also send some, and there are a lot of Cyclotron Road, for example, here, I'm refer that. They invite international companies. There's this other amazing venture capital called One Way Ventures in the US. They do a lot of like immigrant-led companies. So, you don't necessarily have to move your entire shop and everything to a different country, but you can have a leg that allows you more access to capital and
Yeah.
or innovation and or reverse innovation, right? You could get some IP elsewhere that you can contribute it into your company and go to a family office domestically. So there are ways to do it, but I think thinking a little bit beyond your backyard, I think, is the first message I would put out there for a hardware startup.
Awesome. Awesome. This was amazing. And Arvind, coming back to you, we need to take a few questions, but very importantly, you need to publish a few things that Abhijit recommends. Over to you, Arvind. Thank you.
Yeah, I think we have a few people who might have questions, but I think in the chat, one quick question that came up is what about consumer tech startups? And I think it's a pretty broad question. So how does that fit into this?
So I'll be really honest. When it comes to consumer tech, I definitely am not the expert at it, primarily because, in my view, the repeatability is a challenge, is what I find. Because a consumer that you're talking about hardware, when you say consumer tech, again, it's broad. So if you're talking about consumer tech from an innovation economy standpoint, is that what you're referring to, or are you referring to like
I think this question was more if you're doing hardware, but this is B2C and not B2B.
like
How would you
your
go
market?
about raising money or doing customer pilots or getting customers' money in that kind of context? I think the question was asked.
So that's where I would say that I think again, I've never done B2C in all my, and most of my startups have always been in either climate change and or changing, bringing in to industry. But the lot of and I think the main difference is your early stage there. How you get your first checks and who actually backs them are very different. That's why you will also see that there was a dichotomy with, investors who are doing consumer tech versus doing B2B. You'll see a lot of them understand it. So it's a lot more growth hacking. It's a lot more kind of getting your customer, getting kind of a lot of your early stage market in place in a certain region that the customers accepted. So you have to be a little bit regional because you is what I read, but I really won't be able to specifically talk about consumer tech only because I've not done too much of that. But I don't know, Gagan, have you had such experiences before?
No. I'm absolutely unqualified to comment on this. I will refrain totally.
Assume there'll be a lot more early marketing cost, right? That's what immediately comes to me. Like if I have to get a customer happy, I have to put a lot more in my SEOs and I have to do a lot of growth hacking and kind of because again, so Arvind, the question I think we need to ask is it intellectual property led B2C or is it just hardware B2C, right? That these again take different forms.
Yeah, I think the question was from somebody called Chirag, and he runs a company called Inner Life.
Yeah.
Basically, it's about thermal comfort. It manages the balance between your ceiling fan and your AC to kind of give you thermal comfort throughout the night. And I think that's the kind of place that it was. But that's okay. I think we can always take more questions. So
Yeah.
we have a few people on the call. So if anybody wants to unmute or put your questions in the chat, we'd love to address them. Maybe you're building something, maybe you're thinking of building something, maybe you're already ahead in your journey. Please go ahead.
By the way, the other bit before on the consumer tech, I was at CES in Jan, and I saw some of the amazing Indian startups come there, and they were just pitching for the 4 days, and they got probably about 50, 60 customers there worldwide to try this out. And many customers were talking about them on Instagram. That's the best marketing. So figure out the right conferences for you and just go for it. Because as many people demo your product, and it doesn't have to be very, very fancy. It has to be just the right first set of demos. It creates a huge buzz. But yeah, over to you guys.
So we have one more question. So this is Jiten, who runs a company called Ambiator. They're also solving for human thermal comfort in hot and dry weather. They're also part of the SusMafia community. He asks, how do you think we can solve for quality control issues with outsourced manufacturing? And I think that's one part when it comes to the manufacturing. And the second part is, what are some unsecured debt options?
Okay. So I think so. When see, if you're referring to quality control in your early piloting, but I mean, we can say a lot of things, but you can't really quality control. I mean, you have to. It is an iterative process in your initial pilots. It is an iterative process. I think what's more, if are you referring to early stage or later, Arvind? I mean, that's important. So
I
we
think
answer
in the case of Jiten, he's relatively on the early stage. Yes.
early stage. The quality, I think you're thinking too ahead then. I think you have to first you have to have a customer that's willing to iterate with you, right? I mean, I think your first pilot has to be it's an iterative process. And I do not know why for an early stage pilot I mean, if you're doing contract manufacturing for a pilot, I see that I see that as a slightly risky endeavor, um, unless you've got the contract guy vested in the success of the project. If you've contractually just given him a contract to execute on your pilot project and he's not vested in its overall kind of success, that is a slightly risky endeavor. But because yeah, so incentivize the contract manufacturer in either equity or in the success of the project, and that's a much better way to do it. Of course, sourcing the right contract manufacturer will become super critical. And I think that if there are certain areas in which you feel that the specific item or the equipment can fail, then I think you have to have back-to-back warranties and guarantees built into your contract manufacturing setup because you cannot at an early stage take care of all problems that can come up in a contract manufacturing. But did that answer your question?
Yeah, he's on
The
LinkedIn. He
second
can't
thing,
respond to us, but
and
hopefully that did. Yeah.
the second question was unsecured loans.
Unsecured
Yeah.
debt. Yeah. Yeah. Essentially.
So unsecured debt is, I mean, when you say unsecured, so if you're referring to early stage debt, right, and without security, that is not debt typically. That is equity, right? I mean, because you cannot, you cannot. I mean, you will be able to get. There are sources where you will able to get non-dilutive equity. Let's put it that way, which is unsecured. Um, but you're paying an arm and a leg in exchange for it. So it is, in fact, in certain cases, more expensive than equity. Um, but yeah, so I don't really dwell in that. There is that we've seen this, especially because in the solar sector, you do get a lot of unsecured financiers who say, you know what, we will be able to help you in your early stage but they don't also do intellectual property. You can't get unsecured debt for intellect IP led businesses, guys. Have you had experience with unsecured debt in India? Or like, do you know where?
We've had an investor give us that, but they
It's
already had
more
a
quasi
system.
equity, right? It's not really debt, I
So
think.
it's basically like they want us to succeed. We've already have them on the cap table, so they're most happy to
Okay,
extend
but
the
then,
loan.
yeah, if they're on your
Yeah.
cap table, then it's kind of equity. Yeah, that's what
Correct. Correct.
it's
And
equity, basically. Yeah.
yeah, and tomorrow that portion of that unsecured debt can be converted into equity or can be converted. I mean, we can pay them back after a major funding round. But fundamentally, I mean, somebody needs to believe in you and support you. You go to a third party to secure an unsecured debt, that seems very
Exactly. I was referring to third party unsecured debt, right? I mean, it has to
right.
be, it's one of the founders or family and friends around kind of stuff who's giving it unsecured debt. I think that is fine because
Yeah.
they are vested in the success of your project. But
Yeah. Yeah. Yeah.
if it is a normal third party
Anybody who's
unsecured
not
debt,
on the cap table, it's very hard to raise unsecured.
very hard to.
Yeah.
Yeah, yeah, okay. Yeah, and I think that also when you're building when you're in your early stage when you're building this initial traction, uh, you will need there will be some uh, upfront capital that can be possibly sourced from the customer itself. Now, again, I've seen this happen a couple of times, but and how this typically happens is there are things that the customer says, look, I can give it to you for free of cost, right? Like, maybe the land or civil works. I've seen in certain cases, if there's some civil works, the customer says, you know what, I'll get the civil works done. But I don't get into civil work. So also early stage, don't invest in anything that you can't take out if subsequently. Like don't invest in like some site enabling infrastructure or other things that are immovable subsequently because that becomes very critical there. So anyway, I don't know if that answered your question.
Yeah, I think we have time for one more. I think we are kind of 7 minutes over time as well. I think the last question that we'll take is for startups in a very, very early stage. What do you, if you have limited funds, do you prioritize product development or patenting? I think the answer is quite clear, but go for it.
See, if I mean again, the way Gagan separated the two startups, right? Startup A, startup B. If you have very limited funds, you should not do the startup A. There's no way you would be able to do it because intellectual property still doesn't get kind of food on the table, right? I mean, patents don't. You have to go get revenue. You have to go get contracts. So if you've got limited and if you're doing marginally improved technology, I would I would definitely uh, not recommend you hold intellectual property, not necessarily file patent, if you understood what I meant. So get your, make sure that you're doing that piloting and product development with with a customer that you know or with a team that you know well, so you don't have to go to the market and publicly, declare it or show it. Because once you IP or patent is required when you know that your innovation is easily copyable, repeatable. You can go into it. people can re-engineer. If those problems are not there, then of course, just focus on product development, focus on your initial customer happiness, as I call it, first two, three. That's all it's required. Product doesn't have to be perfect, just that the customer should know that there is some value there and is willing to attest it. I think your first certificate from a good marquee customer is all that is required. Sometimes there have been cases where the pilots have miserably failed, but the customer is so happy with the amount of energy and the work that the team put in getting it to where it was, that there was at least another conversation subsequently. So it's also about your early stage commitment to the project that kind of works, and that's come back to having a good team.
We have one more. Given my current stage, close to MVP, I think their work is close to MVP. What are the most effective strategy for attracting angel investors or seed funding for hardware startups in agri-tech? Their solution is robotics for marginal farmers. So any particular view on the
That's
agri-tech?
awesome. I mean, yeah, I mean, so in terms of strategies, I think one of the most important things, and I may have said this more than once on in this call, is being able to demonstrate if it is. So when you tell say or robotics for agri-tech, it's basically automating certain part of possibly agriculture, right? That way, I think that's what the startup does. How does that make a difference? Is it in time? Is it in cost? Is it in efficiency? And show data for that. First, I'm doing a startup. I'm innovating. I'm building robots for agriculture. It's fine, but and I have an MVP. But what does the MVP? What does the product actually do in time, distance, and form? Like that data is what an angel investor is looking for. So, and if you've not yet gone into the market with the MVP and you have not generated data, an angel investor is not going to look at it. Or if they good look at it, they're like, yeah, okay, but how do I know your product works? So, um, so that is one. I think having some form of a small pilot with the MVP is important, and it could be as small can be, but that would be your first point. The second thing is with angel investors is choose an angel investor who understands agriculture, who understands, uh, and there are nowadays, a lot of forums and frameworks. Sorry, a lot of forums that you can actually choose angels who are focused in a certain sector and look at their backgrounds on LinkedIn, and then, in fact, even cold call, specifically when it comes to angel investing. So I think those are a couple of quick things that come to my mind on it. Gagan, anything on robotics that you have to share?
Um, yeah, no, not really. I mean, one couple of things that I would do is look at, if I'm going into robotics, what is the current market doing? So I would go look at mechanized equipment providers, and I would see if there is someone who could potentially back me in getting through the first lot. I could potentially also go to a manufacturer and say, hey, I need your help. If you help me, the mechanical bit will be supplied by you, and I will go do this. I think there are different forms of partnerships where you can incentivize this supplier or the player who is enabling your go-to-market to make it easier there. And then within that community, if you're successful, I think it's very easy to raise angel. The other bit that I would do is look at, I mean, you're doing for agri-tech, fair. but just look at in general who are the top angels for robotics, because they know how robotics has worked or hasn't worked. And to Abhijit's comment, I would just go there and call them or email them and figure out a way to reach out to them and say, what's your opinion on this? Can I get your advice? Get a couple of them on your board of advisors if they are really good, if they have invested before, and they will open the doors further for you. So these are the two things I would probably try.
Awesome. I think we do have one more question, but I think we will probably address it after the fact. I think we are way over time, and I don't want to extend beyond what we've already done. So Hitishi, we'll get this question and we'll address it in the comments on the LinkedIn post. But thank you so much, Gagan and Abhijit.
Guys.
Because a lot of it was new for me personally, and I'm sure a lot of the people who tuned in. And a lot of it was also deep and very, very use case centric. So thank you so much for exploring that A and B as such. So hopefully AI will, when somebody searches for hardware startups, and the chat GPT will hopefully pick up the transcript from this YouTube and add to that. And of course, our own communities will take value from this. Thank you so much.
Thanks.
Brilliant.
Thanks, Gagan. Thanks a lot. I mean, you yourself come with a phenomenal amount of experience, and you're actually doing deep tech in a part of the world that has never really done as much as we discussed. So, kind of all the best for that. And I think it's great to really get into the depth of innovation. And I do see a significant change in the last 3-4 years in that space in India. So I think it is definitely amazing. Thanks, SusMafia, Arvind, Saksham. It's been an amazing opportunity. And I think we look forward to doing more collaborative sessions and supporting the community, make some good change. Thank you.
Thank you so much for being there and the insights. Brilliant. I think we hopefully a couple of entrepreneurs will use these and make their fundraising less friction and more fruitful. But yeah, brilliant.
Perfect.
All around. Thank
Thanks,
you.
guys. Thank you.
Bye.
Cheers.